Approach to real estate valuation. The cost approach is a real estate valuation method that estimates the value of a property by determining how much it would cost to replace or reproduce the building, the structure, while accounting for depreciation and adding the value of the land. This method is often used when it's difficult to find comparable sales, as in the case of special use properties or new construction, or when the property is unique and not easily compared to others. The premise behind the cost approach is that a buyer would not pay more for a property than it would cost to build an equivalent structure on a comparable piece of land. It is particularly useful when valuing new or nearly new properties, as the replacement cost closely reflects the property's value. Formula for the cost approach: text property value equal text cost of replacing the building, text depreciation, land value, where cost of replacing the building, the current cost of building the structure or its reproduction cost. Depreciation, a reduction in value due to physical wear and tear, functional obsolescence, or external factors. Land value, the value of the land based on its market price, independent of any buildings or improvements. Steps in the cost approach. 1. Estimate the land value. The value of the land is typically determined using the comparable sales approach. This involves finding similar vacant parcels of land in the same or comparable locations and using the sale prices to estimate the subject property's land value. 2. Estimate the cost of replacing or reproducing the building. There are two ways to calculate the cost of the building. Replacement cost, the cost to build a structure of similar utility using modern construction materials and standards. This doesn't necessarily involve duplicating the exact building, but replicating its functionality. Reproduction cost, the cost to build an exact replica of the existing structure using the same materials, construction techniques, and architectural features. This is more appropriate for historic or special use properties. 3. Determine depreciation. Depreciation accounts for the loss in value of the building over time due to various factors. Depreciation is usually broken down into three main categories: physical deterioration, wear and tear from regular use, weather, and aging; functional obsolescence, loss of value due to outdated design or features that are no longer practical or desirable, e.g., poor layout or lack of modern amenities; external obsolescence, depreciation caused by external factors, such as changes in the neighborhood, economic conditions, or environmental changes that negatively affect the property's value. 4. Calculate the total depreciation. Total depreciation is subtracted from the replacement or reproduction cost to reflect the current condition of the building. 5. Add the land value. Finally, the depreciated building value is added to the estimated value of the land to determine the total property value. Example of the cost approach. Let's say you're valuing a property with the following characteristics. Land value, $200,000. Replacement cost of the building, $500,000 is. Depreciation, 20% due to physical wear and functional obsolescence. 1. Land value, $200,000. 2. Replacement cost, $500,000. 3. Depreciation, 20% depreciation on $500,000 equals $100,000. 4. Depreciated value of the building. Depreciated building value equals $500,000 minus $100,000 equals $400,000. 5. Total property value. Text property value text land value. Text depreciated building value equals $200,000, $400,000, $600,000. The estimated property value using the cost approach is $600. Types of depreciation in the cost approach. 1. Physical deterioration. This refers to the natural wear and tear of the property over time due to factors like age, weather, or lack of maintenance. Physical deterioration can be curable or incurable. Curable physical deterioration. Issues that can be fixed through repairs or maintenance, e.g., painting, fixing a leaking roof. Incurable physical deterioration. Issues that are either too costly or impossible to fix, e.g., foundation problems. 2. Functional obsolescence. This occurs when a property loses value because its design, layout, or features are outdated or inefficient compared to modern standards, e.g., a building without elevators or central air conditioning in a market where these features are expected. Functional obsolescence can also be curable if upgrading the features is feasible, or incurable if the cost of updating is too high relative to the benefit. 3. External obsolescence. This form of depreciation occurs due to negative factors outside the property, such as changes in the neighborhood, environmental concerns, or economic shifts. For example, a nearby factory causing pollution might reduce a property's value. Advantages of the cost approach. 1. Useful for new construction. The cost approach is ideal for newly constructed properties because the replacement cost closely approximates the property's value, and depreciation is minimal or non-existent. 2. Effective for special use properties. For unique or special use properties, e.g., schools, hospitals, churches, the cost approach is often the best method because there may not be sufficient comparable sales or income data available. 3. Objective. Since the cost approach is based on the actual cost of building materials and labor, it offers an objective measure of value, particularly when there are limited market transactions for comparison. Disadvantages of the cost approach. 1. Difficult to estimate depreciation accurately. Estimating depreciation, particularly functional and external obsolescence, can be subjective and challenging, leading to inaccuracies. 2. Not ideal for older properties. As buildings age, depreciation becomes more complex to assess, and the replacement cost may no longer reflect the property's market value. For older properties, the comparable sales or income approach is often more appropriate. 3. Ignores market conditions. The cost approach focuses on construction costs and depreciation without considering real-time supply and demand dynamics, buyer preferences, or market conditions. As a result, the value derived from the cost approach may not reflect the actual market value of the property. 4. Less relevant for income-producing properties. The cost approach does not take into account the income a property generates. For income-producing properties, the income approach, capitalization of net operating income, is often more suitable. When to use the cost approach. New construction. The cost approach works well when valuing newly built properties where depreciation is minimal and replacement costs are easy to calculate. Special use properties. It is appropriate for properties that do not have direct comparable sales or income streams, e.g., churches, schools, or government buildings. Insurance purposes. The cost approach is often used in insurance appraisals to determine the cost of replacing a property in the event of total loss. Comparison to other valuation methods. 1. Comparable sales approach, market approach. This approach estimates property value based on recent sales of similar properties in the same area. It is the most common approach for residential properties. Cost approach versus comparable sales. The cost approach is more appropriate for new or special use properties, while the comparable sales approach works better for properties with a lot of recent, similar sales data. 2. Income approach. The income approach values a property based on the income it generates, primarily used for income-producing properties such as rental apartments, office buildings, and commercial spaces. Cost approach versus income approach. The cost approach doesn't account for rental income or return on investment. The income approach is more relevant for investors focused on cash flow and return. Conclusion. The cost approach is a fundamental valuation method that estimates the value of a property by adding the land value to the depreciated replacement cost of the building. It is particularly useful for valuing new construction, special use properties, and properties where comparable sales data is not available. However, it has limitations in older properties and in markets where income generation is a key factor in determining property value. By focusing on the actual cost to replace a building minus depreciation, the cost approach provides a practical method for determining property value, particularly when combined with other valuation methods like the sales comparison or income approach.